So now it looks like another pressure point has appeared. Cuba is being discussed again. The United Arab Emirates is leaving OPEC. Oil is above $100. Gasoline is setting new pressure points for ordinary families, and one of America's closest Gulf allies has said, in effect, that if it runs short of dollars, it may have to use yuan or other currencies to keep its oil trade moving. Most people hear that and think it is a story about oil. It is not only a story about oil, it is a story about power, it is a story about leverage, it is a story about what happens when a system that worked for 50 years starts to show its weaknesses. When I study systems, I look for the machine beneath the headline. The headline is the UAE leaving OPEC. The machine beneath it is the petrodollar system. The pressure point is the Strait of Hormuz. The leverage is held by Gulf states that own large amounts of American assets. The deeper risk is that the dollar's position as the world's reserve currency is no longer being accepted as unquestionable. That is the part most people are missing. The UAE was not some marginal player. It was a founding member of OPEC. It was part of the oil cartel architecture that helped shape global energy markets for decades. When a country like that leaves, the question is not only what happens to oil production quotas, the bigger question is what happens to the monetary order that oil helps support. Just before this announcement, the UAE warned that if it ran low on dollars because of the Iran war, it might be forced to use yuan or other currencies. That is not a small statement. In plain terms, it means this. If the dollar system does not provide enough liquidity, and if the war disrupts the flow of oil and dollars, then a Gulf ally may turn to another currency to keep functioning. And once oil begins to move outside the dollar system in a significant way, the old machine becomes less certain. That is why the reaction from the United States matters so much. The American Treasury Secretary said that swap lines could be used to maintain order in dollar funding markets and prevent the disorderly sale of US assets. That sentence is very important. It is a polite way of saying that these countries hold enough American assets that if they were forced to sell them quickly, it could create instability in American markets. The Gulf Cooperation Council collectively holds more than $2 trillion in U.S. assets. That is not symbolic, that is leverage. If those assets are sold in a disorderly way, the selling pressure can move markets, it can affect treasuries, it can affect stocks, it can affect the dollar funding system, it can affect the cost of capital inside the United States. So the United States faces a hard choice. It can allow the Gulf states to scramble for dollars and potentially sell American assets, or it can provide dollar liquidity through swap lines and keep the system stable for now. That is how leverage works in the real world. The country that issues the reserve currency has enormous power, but it also has obligations. If too many countries depend on your currency, then their dollar shortages become your problem. If they hold too many of your assets, then their need to sell becomes your problem. This is the paradox of a reserve currency. It gives power, but it also creates dependencies that must be managed. And when the system is stressed by war, energy disruption, debt, and inflation, the dependencies start to show. At the same time, we see political noise around Cuba, aircraft carriers, and displays of force. Those things may matter, but I try not to let the visible theater distract me from the underlying mechanics. In my view, the core issue is not whether a country can project military power for a news cycle. The core issue is whether the financial system that supports that power is becoming more fragile. That is the real story. To understand it, we have to go back to 1971. In 1971, President Nixon closed the gold window. Before that, the dollar had a link to gold. It was not a perfect system, but it meant foreign governments could convert dollars into gold. That placed a restraint on American money creation. When the gold window closed, the dollar was no longer backed by gold. It became a fiat currency. It was backed by confidence, by U.S. power, by the depth of American markets, by the rule of law, by military strength, by economic scale, and by the willingness of the rest of the world to keep using it. But there was a problem. If you are an oil-producing country and you own a finite resource, why would you sell that resource for a currency that can be printed in unlimited quantity? Oil is real. Paper money can be created. A rational oil producer must ask what it receives in exchange for its finite asset. That question led to the arrangement that became known as the petrodollar system. In 1974, Henry Kissinger went to Saudi Arabia and helped build a deal. The basic structure was simple. Even if the details were not broadcast clearly to the public at the time, Saudi Arabia would price oil in U.S. dollars. Those dollars would be recycled into U.S. Treasury bonds. The United States would provide military protection and weapons. Oil producers received security. The United States received structural demand for dollars and treasuries. Every country needed oil. If oil was priced in dollars, every country needed dollars. That created a constant global bid for the dollar. It gave the United States what economists call an exorbitant privilege. The U.S. could run larger deficits, it could borrow more cheaply. It could import goods and export paper claims. It could finance power through the rest of the world's need to hold dollars. That was the machine. Oil created demand for dollars. Oil exporters recycled dollars into treasuries. Treasury demand helped fund U.S. deficits. U.S. military power protected the oil producers. The system reinforced itself. OPEC played a role in that world. OPEC managed supply among major oil producers. It helped create discipline inside the oil market. It helped keep the oil pricing architecture stable in a world where the dollar was no longer backed by gold. Oil became one of the practical anchors for global dollar demand. That is why the UAE leaving OPEC is more than an energy headline. It is a crack in a structure. When countries that were part of the old oil order begin acting independently, when they begin discussing yuan, when they deepen relationships with China, when they ask for dollar swap lines to avoid selling us assets, the system is not dead. But it is changing. A system does not usually break in one day. It weakens through a series of pressures. One pressure is the end of the old petrodollar agreement framework. Another pressure is the war with Iran. Another is the closure or restriction of the Strait of Hormuz. Another is China's rise as a commodity buyer and industrial power. Another is the loss of trust caused by sanctions and frozen reserves. Another is the rising U.S. debt burden and the sensitivity of the bond market. When all of these forces happen together, you need to pay attention. The Iran war changed the math for Gulf countries. The Strait of Hormuz is not just a narrow body of water. It is one of the most important choke points in the global economy. Roughly 1/5 of the world's oil and gas supply moves through it. Saudi Arabia, the UAE, Kuwait, Qatar, Iraq, and other producers rely on that route to move energy to global markets. When the route is disrupted, their revenue model is disrupted. This is not theoretical. Oil-producing states use oil revenue to fund imports, social programs, public employment subsidies, infrastructure, defense, and political stability. Their budgets are built around flows of oil and flows of dollars. If oil cannot move normally, revenue falls. If revenue falls, reserves are drawn down. If reserves fall, currency pegs come under pressure. If currency pegs come under pressure, the need for dollars becomes urgent. That is the chain. And in a crisis, the chain moves fast. Saudi Arabia, for example, needs a certain oil price and a certain export volume to support government spending. If volume falls because exports are disrupted, the price has to rise dramatically just to keep revenues stable. Some calculations suggest that Saudi Arabia would need oil far higher than current paper prices to generate the same revenue under restricted export conditions. If the market price does not rise enough, then the country bleeds cash. It borrows externally, it draws reserves, it looks for liquidity, and if it cannot get liquidity, it may sell assets. That is why the swap line discussion matters. The Gulf states are essentially saying, we need dollars, we own your assets. We could sell them to get dollars, but if we do, your markets may not like it. So give us dollar liquidity. That is leverage. It is not emotional, it is mechanical. Every balance sheet has assets and liabilities. Every country has flows and reserves. When flows are interrupted, reserves matter. When reserves decline, assets may be sold. When large assets are sold quickly, markets move. That is the system. Now look at China's position. China has been building relationships patiently. It buys enormous amounts of energy. It has become a major trading partner for Gulf countries. It has built industrial capacity. It has accumulated commodity relationships. It has developed alternative financial plumbing. It has encouraged trade in yuan. It has positioned itself as the buyer that can offer another path in the timeline. The UAE Crown Prince meets with Xi Jinping. The UAE and China sign many trade and investment agreements. Reports emerge about the yuan threat. The United States discusses swap lines. Then the UAE leaves OPEC. When you look at these events as isolated headlines, they seem confusing. When you see them as a negotiation inside a changing monetary system, they become clearer. The UAE strengthens its China option, then it uses that option as leverage with Washington. That is how power works. Options create bargaining power. If you have only one buyer, you have little leverage. If you have two systems competing for your resources, your leverage rises. The Gulf states understand this. China understands this. The United States understands it too, which is why the swap line conversation happened. The United States can still provide what China cannot fully provide. deep dollar liquidity, treasury market access, military reach, and the broadest financial markets in the world. But China can provide something the world increasingly wants: an alternative. Sometimes an alternative does not need to be better in every way. It only needs to be credible enough to change the negotiation. That is what is happening. China is not winning because the dollar disappears tomorrow. That is not how reserve currencies work. China is winning because it is forcing the world to price optionality into a system that used to have less of it. The dollar is still dominant, but it is no longer unchallenged in the same way. That shift matters. Now there is another layer: rare earths and military production. The United States is financially powerful. It can create dollars, it can issue treasuries, it can move capital markets. But wars are not fought with spreadsheets. Wars require physical things: missiles, interceptors, aircraft parts, ships, ammunition, rare earths, tungsten, industrial capacity. The United States has spent decades financializing its power. China has spent decades building and controlling supply chains for critical materials. That difference matters in a conflict. If the U.S. depends on Chinese-controlled materials to produce the weapons it needs, then financial power alone does not solve the problem. You cannot print rare earths, you cannot print missiles, you cannot print industrial capacity that takes years to build. This is why the old idea that money and markets alone can substitute for production becomes dangerous. A country can have the world's strongest currency and still be vulnerable if it lacks the physical inputs needed to sustain its strategy. China knows this. It controls a large share of rare earth mining and an even larger share of processing. These materials are important for missile systems, fighter jets, precision, guided weapons, electronics, and defense production. So when the U.S. calls China an unreliable trading partner, there is an irony. The United States wants China to provide the materials that support American military capability, while also expecting China to finance or participate in the dollar system that helps fund American power. That is an unstable relationship. The deeper principle is this: financial power without industrial depth becomes fragile under stress. For 50 years, the United States benefited from a system where it could issue dollars and treasuries while the world produced goods, energy, and materials. That worked because the world trusted the dollar and because American power enforced the structure. But if trust declines, if industrial dependencies become obvious, and if other countries build alternative settlement systems, the old arrangement becomes less stable. That does not mean collapse. It means transition. Transitions are where investors need to be careful. The dollar's share of global reserves has declined over time. It was around 72% in 2001. Today, it is in the 50s. It remains the largest reserve currency by far. But it is no longer the same monopoly. What is replacing some of it? Gold. Central banks around the world have been buying gold at the fastest pace in decades. These are not speculative retail traders. These are the institutions that manage national reserves. Why would they hold more gold? Because gold is not another country's liability. A treasury bond is someone's asset, but it is also the U.S. government's liability. It exists inside the legal and political framework of the United States. If the U.S. freezes reserves, sanctions assets, or uses financial plumbing as a weapon, foreign governments notice. After Russia's reserves were frozen in 2022, every central bank asked the same question: if this can happen to Russia, could it happen to us? That question changed the reserve management calculus. Even countries that do not like Russia could still understand the risk. The issue was not whether Russia deserves sanctions. The issue was that reserve assets could be frozen by the issuer of the reserve system. Once that becomes obvious, gold becomes more attractive. Gold has no counterparty. Gold cannot be frozen in the same way if it is held directly. Gold does not depend on another government's promise. This is why central bank gold buying matters. It is not a doomsday signal by itself. It is a diversification signal. It says that the most conservative financial institutions in the world are reducing dependence on paper claims tied to one country's political decisions. That is a very important signal. At the same time, China has been building alternative financial channels. Yuan clearing banks now operate in major financial centers. Commodity deals increasingly include yuan pricing. Countries such as Iran, Russia, India, and others have experimented with trade outside the dollar. This does not replace the dollar overnight, but it creates pathways. And once pathways exist, they can be used more in periods of stress. That is how systems change. First, the alternative is small. Then it becomes convenient for certain trades. Then it becomes strategic. Then it becomes a bargaining tool. Then, in a crisis, it becomes necessary. That is the progression. Now, the bond market enters the story. When investors lose confidence or demand more compensation for risk, they ask for higher yields. The 10-year Treasury yield becomes a key pressure gauge. If yields rise too much, the U.S. government's borrowing costs rise, mortgage rates rise, credit markets tighten. Asset valuations come under pressure. The federal deficit becomes more expensive to finance. This is why bond markets can constrain policy. The United States may be powerful militarily, but if the Treasury market becomes unstable, the government has to respond. Foreign policy, fiscal policy, and monetary policy all become connected through the cost of funding. This is the world we are in. Each time yields approach levels that create stress, policymakers become more cautious. They may extend pauses, they may moderate actions, they may seek liquidity arrangements, they may try to calm markets. This does not mean the bond market literally writes foreign policy, but it means financial conditions limit what policymakers can do without consequences. That is a major change from a world where the United States could assume unlimited demand for its debt at manageable rates. If Gulf countries need swap lines, if foreign buyers demand higher yields, if central banks buy gold instead of treasuries, if China builds alternatives, if oil routes are disrupted, if inflation rises from energy and fertilizer, then the U.S. policy machine becomes more constrained. That is the key insight. The constraint is not only military, it is financial, it is monetary, it is industrial, it is supply chain based, and all of those constraints are interacting. Now consider the Strait of Hormuz again. It is not only oil, it is also fertilizer, related flows and energy inputs that affect food production. Higher energy prices feed into shipping, agriculture, manufacturing, and consumer prices. If fertilizer flows are disrupted, the inflationary effects can be delayed but severe. Food inflation is politically dangerous because it affects everyone. Energy inflation is dangerous because it moves through everything. If the strait remains restricted for months, the inflation pressure does not remain contained in oil charts. It moves into groceries, transportation, margins, wages, rates, and politics. That is why this war is not just a military conflict. It is an economic war. Iran understands the leverage of geography. The United States understands the leverage of finance. China understands the leverage of supply chains. The Gulf states understand the leverage of assets and energy. Each side is using the leverage it has. That is what makes the situation complex. It is not one battlefield. It is a system of battlefields: oil, dollars, treasuries, gold, rare earths, shipping lanes, fertilizer inflation, bond yields, stock valuations. If you are an investor, you cannot look at only one piece. You have to look at how the pieces connect. Now let us bring this to portfolios. The stock market is pricing in a lot of optimism. It is pricing in strong AI productivity. It is pricing in a relatively quick end to the Iran war. It is pricing in manageable inflation. It is pricing in financial stability. It is pricing in the idea that the Treasury market remains functional and that policymakers can keep extending the system. Maybe that happens, but if any of those assumptions are wrong, the market's valuation can change quickly. One way to think about valuation is the total value of the stock market relative to the economy. Some analysts use versions of the Buffett indicator, adjusting for debt and other factors to understand whether markets are expensive relative to the productive base. There have only been a few moments in modern history when broad market valuations reached extreme levels relative to the economy: the dot-com bubble, the everything bubble, and now, in past cases, markets eventually experienced large declines and took time to recover. That does not mean the same thing must happen immediately. Markets can remain expensive longer than cautious investors expect, but it does mean the margin of safety is lower when valuation is high and geopolitical risk is high and bond market sensitivity is high and inflation risk is high. You should not behave as if nothing can go wrong. That is complacency. And complacency is dangerous late in a cycle. I am not saying sell everything. That is usually not a good principle. I am saying the environment calls for caution, liquidity, diversification, and an awareness of what assets are likely to perform. If the assumptions break, cash has value because it gives optionality. Gold has value because central banks are telling you through their actions that they want assets outside the dollar liability system. Bitcoin may matter to some investors because it represents another form of non-sovereign scarcity, though it has its own volatility and risk profile. Energy matters. Because choke points in war can create supply shocks, high-quality equities still matter because productive assets can compound over time, especially if they have strong balance sheets and pricing power. But the sizing matters, the timing matters, the risk control matters. The mistake is not being invested. The mistake is being invested as if the system has no constraints. Every system has constraints. The old petrodollar system reduced constraints for the United States. It created structural dollar demand. It helped fund deficits. It kept treasuries supported. It made the dollar necessary because oil was necessary. Now that system is being tested. The UAE leaving OPEC is one test. The yuan threat is another test. The Gulf swap line request is another test. China's commodity and rare earth leverage is another test. Central bank gold buying is another test. The 10-year Treasury yield is another test. The Strait of Hormuz is another test. When many tests occur at the same time, you do not need to predict the exact breaking point to know the system is under stress. Good investors do not wait until the collapse is obvious. They watch the pressures build. They ask what would happen if the system has to adjust. They ask who has leverage. They ask which assets depend on confidence and which assets benefit when confidence erodes. They ask whether the market is pricing risk correctly. Right now, I think investors are more complacent than they should be. That does not mean a crash is guaranteed. Nothing is guaranteed. But the asymmetry has changed. When markets price perfection, negative surprises matter more. When valuations are high, policy mistakes matter more. When inflation is sensitive, energy shocks matter more. When debt is high, bond yields matter more. When reserve trust is weakening, gold matters more. That is the structure. And in this structure, the petrodollar story is central, because the dollar's dominance is not just a financial abstraction. It affects American living standards. It affects the cost of imports. It affects interest rates. It affects deficits. It affects asset prices. It affects the government's ability to respond to crises. It affects the value of savings. It affects global power. If the world needs fewer dollars to buy oil, then structural demand for dollars weakens. If oil exporters recycle fewer dollars into treasuries, the U.S. must find other buyers or pay higher rates. If higher rates increase debt, service costs, fiscal pressure rises. If fiscal pressure rises, the temptation to create more money rises. If more money is created, inflation pressure and debasement concerns rise. If those concerns rise, gold and other scarce assets become more attractive. That is the chain. Not every link happens in a straight line. There will be rallies, reversals, interventions, headlines, deals, and pauses. But the direction of the pressure matters. The United States still has enormous strengths. It has the deepest capital markets. It has the world's most important technology companies. It has military reach. It has a dynamic private sector. It has strong institutions compared to many alternatives. It has the dollar network. It has rule of law advantages. So I am not arguing that America is finished. That is lazy thinking. The better way to think is this. The United States remains powerful, but its margin for error is shrinking. When a powerful system has less margin for error, shocks matter more. That is where we are. The UAE leaving OPEC is not the end of the dollar, but it is part of a larger adjustment. The swap line discussion is not a collapse, but it shows dependence. China's yuan deals do not replace the dollar tomorrow, but they create alternatives. Gold buying by central banks does not mean treasuries disappear, but it shows a desire to diversify away from U.S. political and financial risk. The 10-year yield at stress levels does not automatically crash the system, but it shows the bond market has a threshold. Hormuz being restricted does not automatically create global famine, but it raises energy and fertilizer risk. This is how major transitions happen, not in one dramatic event. In a series of indicators that most people ignore because each one by itself can be explained away. The disciplined investor connects them. This is what I would do conceptually. I would hold more liquidity than usual when markets price perfection and geopolitical risk is high. I would avoid overexposure to assets that require a perfect outcome. I would maintain exposure to high-quality productive assets because long-term compounding still matters. I would hold some hard asset protection because currency systems are under pressure. I would pay attention to energy and supply chains because they are the transmission mechanisms from geopolitics to inflation. I would watch the 10-year Treasury yield because it tells me when financial conditions are becoming too tight. I would watch gold because it tells me what central banks are doing with their trust. I would watch the dollar's share of reserves because it tells me how fast the old order is eroding. I would watch China's commodity settlement deals because they tell me whether alternatives are becoming real. I would watch the Strait of Hormuz because it tells me whether energy inflation becomes a temporary spike or a structural problem. And I would not confuse short-term calm with long-term resolution. Markets are very good at pretending risks are gone just because nothing broke today. But systems usually break after a long period in which the pressures were visible. The key is not to be fearful. The key is to be prepared. Fear is emotional. Preparation is rational. Fear sells everything. Preparation adjusts exposures. Fear predicts collapse. Preparation asks what could go wrong and what assets help if it does. Fear reacts. After the move, preparation thinks before the move. That is how I would frame this environment. The petrodollar system was one of the most important financial structures of the last 50 years. It allowed the United States to convert global oil demand into global dollar demand. It allowed deficits to be funded more easily. It allowed the U.S. to project power through finance. Now the energy producers are looking for options. China is offering options. Gold is being used as an option. The bond market is demanding compensation. The Gulf states are using their asset holdings as leverage, and the war around Iran and Hormuz is accelerating the pressure. This is not a normal oil story. This is a reserve currency story. It is a debt story. It is a war story. It is a gold story. It is a China story. It is a portfolio story. And it is happening now. If you understand it, you do not need to panic. You simply need to respect the system. The old system gave the United States extraordinary advantages. But every system built on confidence must preserve confidence. If the issuer of the reserve currency freezes assets, prints aggressively, runs large deficits, depends on foreign buyers, imports critical materials, and uses financial power as a weapon, other countries will diversify. That is not ideology, that is self-interest. Countries act to reduce vulnerability. The Gulf states are doing it. China is doing it. Central banks are doing it. Investors should at least understand it. The question is not whether the dollar goes away tomorrow. It will not. The question is whether the world is moving from a dollar monopoly toward a more fragmented system. I believe it is. In a fragmented system, the old assumptions become less reliable. Treasury demand is less automatic, oil pricing is less uniform, gold becomes more important, geopolitical choke points matter more, industrial capacity matters more, supply chains matter more, cash and flexibility matter more, valuation discipline matters more. That is the lesson. When the world is stable, investors can get rewarded for believing the machine will keep working. When the machine is changing, investors must understand what parts are still strong and what parts are weakening. The UAE leaving OPEC is one of those signals. The yuan warning is another. The swap line request is another. The central bank gold buying is another. The bond market pressure is another. The market's complacency is another. Taken together, they tell us that the next phase of the global monetary system is being negotiated under pressure. It will not be clean. It will not be announced in one simple headline. It will be messy, gradual, and full of policy responses. But the direction is visible. The dollar system is still dominant. But it is being questioned. The oil system is still essential, but its old cartel structure is weakening. The treasury market is still central, but its sensitivity is rising. China is still not ready to replace the United States, but it is ready to weaken the monopoly. Gold is still not money in the old legal sense. But central banks are treating it as monetary insurance. That is where we are. So when I look at my portfolio in this kind of environment, I do not want to be positioned for only one outcome. I do not want to depend entirely on a perfect soft landing, a quick war resolution, falling inflation, stable bond yields, and endless AI optimism. That may happen, but if my plan only works if that happens, it is too fragile. I want enough exposure to growth if the system muddles through. I want enough liquidity if markets sell off. I want enough hard asset protection if confidence in paper claims weakens. I want enough caution to avoid being forced to sell in panic. And I want enough discipline to not chase every headline. That is the practical conclusion. You do not need to predict every event. You need to understand the cause and effect relationships. If Hormuz remains restricted, energy inflation rises. If energy inflation rises, bond markets become more sensitive. If bond markets become more sensitive, policy becomes constrained. If policy becomes constrained, markets that priced perfection must reprice risk. If the dollar system weakens, gold and alternative reserve assets gain importance. If China controls critical supply chains, U.S. military and industrial policy becomes more constrained. If Gulf states hold large U.S. assets, their dollar needs become market relevant. If swap lines are used to prevent asset selling, then the reserve issuer is supporting the system to buy time. And buying time is not the same as solving the problem. That is the important distinction. Many policy actions do not solve the underlying imbalance. They extend it. Swap lines can prevent disorderly selling. They do not restore the old petrodollar confidence by themselves. Ceasefire extensions can reduce immediate panic. They do not reopen a stable long-term energy system by themselves. Liquidity injections can calm markets. They can also worsen inflation if the physical bottleneck remains. Every solution has side effects. That is why systems thinking matters. The world is not a set of isolated events. It is a set of linked balance sheets, supply chains, incentives, and feedback loops. The petrodollar system was one of the biggest feedback loops in modern history. Oil required dollars. Dollars bought oil. Oil dollars bought treasuries. Treasuries funded deficits. U.S. power protected oil flows. That loop is now under pressure. When a loop weakens, the system searches for a new equilibrium. That search can be volatile. This is why I am cautious. Not bearish on civilization, not predicting immediate collapse, cautious. There is a difference. Caution means respecting risk when markets do not. Caution means holding cash when optionality has value. Caution means owning protection when confidence is overextended. Caution means not becoming intoxicated by narratives that require everything to go right. And right now, a lot has to go right. The war has to end or remain contained. Hormuz has to reopen or remain manageable. Oil has to avoid a severe spike. Fertilizer disruption has to avoid feeding into food inflation. Treasury yields have to stay controlled. The dollar funding system has to remain stable. Gulf states have to avoid disorderly sales. China has to avoid pushing too hard on alternatives. AI earnings have to keep supporting valuations. The Fed and Treasury have to manage the balance between liquidity and inflation. That is many assumptions. When many assumptions are needed, risk is higher than it looks. That does not mean there is no opportunity. In fact, disorder often creates opportunity, but you need liquidity and clarity to use it. The worst position is being fully committed to the most optimistic outcome and then needing to sell when reality changes. The best position is being balanced enough to survive and liquid enough to act. That is the portfolio principle. Survive first, then compound, because in big transitions, the winners are not always the people who predicted the future perfectly. They are often the people who stayed solvent, stayed flexible, and understood the structure better than the crowd. That is what I want you to take from this. The UAE leaving OPEC is not just a news item. It is a sign of a larger negotiation over energy, money, and power. The yuan threat is not just a currency comment, it is a bargaining chip. The swap line is not just a technical tool, it is a recognition that Gulf asset sales could destabilize American markets. The Iran war is not just a regional conflict, it is an economic pressure point through Hormuz. China's role is not just trade, it is the creation of an alternative system. Gold's rise in reserves is not just speculation, it is institutional hedging against dollar weaponization and debt risk. The bond market is not just a yield chart, it is a constraint on policy. And the stock market is not just an AI optimism machine, it is a pricing mechanism that may be underestimating the number of things that can go wrong. That is the system. And once you see the system, you are less likely to be surprised by the headlines. You may not know the exact date. You may not know the exact trigger. You may not know whether the next move is a rally or a sell-off. But you know where the fragilities are. That is enough to make better decisions. In my view, this is a time to think like a risk manager, not like a gambler. Do not chase every move. Do not assume the old system is dead tomorrow. Do not assume it is invincible either. Study the flows, study the incentives, study who needs dollars, study who holds treasuries, study who is buying gold, study who controls energy choke points, study who controls industrial inputs, study what the bond market is saying. Then build a portfolio that can handle more than one future. That is the only rational way to live through a changing monetary order. The petrodollar system gave the United States one of the greatest financial advantages in modern history. But advantages do not last forever unless they are maintained. Trust must be maintained. Industrial strength must be maintained. Fiscal discipline must be maintained. Alliances must be maintained. Energy flows must be maintained. If those foundations weaken, the system does not necessarily collapse, but it adjusts. And the adjustment can be painful for those who did not see it coming. That is why this matters to your portfolio. It affects gas prices, it affects inflation, it affects gold, it affects Bitcoin, it affects treasury yields, it affects the dollar, it affects stocks, it affects the next phase of the global monetary system, and it is being negotiated right now, not in one meeting, but through pressure, war, liquidity, commodities, reserves, and market pricing. That is the world as I see it, not a world to panic about, a world to understand. Because when you understand the machine, you can stop reacting to every noise it makes. You can ask the better question. Not what happened today, but what is changing underneath the system? And underneath the system, the same truth keeps appearing. The old petrodollar order is no longer as unquestioned as it once was. That does not end the dollar, but it changes the game. And when the game changes, the investors who survive and win are the ones who change their assumptions before they are forced to.